Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Navigating market uncertainty, macro data, semiconductor shifts, and strategic plays. This video presents a direct informational narration of the source document. So we've got some absolutely fascinating material to unpack today, looking closely at how hidden anxieties are actually playing out underneath a seemingly calm market surface.
Here is our roadmap for today's explainer. We'll start with macro calm and hidden market anxiety, then move right into Broadcom's perfect storm, NVIDIA's strategic portfolio, Apple as a safe haven, drone tariffs and market shifts, and finally, Ackman's Netflix redemption play.
Section 1. Macro calm, hidden market anxiety.
Let's start right off the bat with this number, negative 0.6%. That is the unexpected month-over-month drop in U.S. retail sales for July. And, even if we completely strip out automobiles, retail sales still dropped by 0.3%. It's concrete proof that consumers are visibly feeling the pinch right now.
What's really wild here is the stark contrast between expectations and reality. The market was actually anticipating 0.1% growth, but reality hit with that 0.6% contraction. The source points to high interest rates, rising energy prices, and sluggish income growth as the primary culprits. And here is the big takeaway. When you combine this with a cooling job market, this data significantly lowers the necessity for a September Fed rate hike. The focus is pivoting very rapidly from inflation over to slowing demand.
So how exactly is the market reacting to all this? Well, the VIX volatility index, which is basically the market's fear gauge, has actually plummeted to its lowest level since January. On the surface, it looks incredibly calm, but trading volume in the broader market has just dropped off a cliff. The document describes this as a calm before the storm, kind of like a spring compressed to its absolute limit. With highly leveraged capital stepping over to the sidelines, this unnatural quiet is really setting the stage for sudden, violent volatility in the weeks ahead.
Section 2. Broadcom's perfect storm. Broadcom recently found itself caught in a perfect storm of headwinds. First up, Google is diversifying its supply chain, which means Broadcom's TPU deliveries for Google through 2027 are going to fall short of the previous 6 million unit hyper-optimistic forecast. Second, Bank of America issued a warning about Broadcom potentially accumulating up to $37 billion in senior debt by 2029. And finally, a 13F filing revealed that Mubadala completely cleared out its Broadcom shares in Q2. But here's a really fascinating twist noted in the source. These aren't entirely new surprises. Much of this is just recycled news, amplified by algorithms to trigger stop-loss orders right around the $400 mark, which temporarily dragged the price down to $388.50 before it rebounded.
Section 3. NVIDIA's strategic portfolio.
While Broadcom battles short-term sentiment shocks, another semiconductor giant is aggressively flexing its strategic muscles. NVIDIA's latest 13F filing, tracking the quarterly holdings of major institutions, is an absolute eye-opener. The source highlights that NVIDIA isn't just selling chips, they're heavily investing. The standout here is an estimated 128 million shares of SpaceX, valuing that position at a staggering $21 billion. Meanwhile, Intel astonishingly remains their largest holding, and they've even increased their position in NVIDIA's. This brilliantly illustrates NVIDIA's immense fundamental strength and their strategy of heavy, diversified capital deployment while others in the space are struggling. Section 4. Apple, the safe haven.
When the waters get choppy, where does the smart money go? I absolutely love this analogy from the text. Apple in the U.S. stock market is like a safe zone in a video game. When the broader market experiences violent swings and uncertainty, institutional capital aggressively rushes into Apple to hide out. It really is the ultimate defensive fortress.
So, how is this practically applied? The source outlines a concrete defensive strategy. Step 1. Buy an initial position in Apple simply as portfolio insurance. Step 2. If the broader market drags the stock down, average down your cost at a specified support line, which is currently around $280. Step 3 is vital. Why do this instead of just betting against the market using a short leveraged fund like SQQQ? Well, because the broader market remains in a bullish structure. Shorting directly carries massive risk right now, whereas Apple provides a safer, directional hedge.
Section 5. Drone tariffs and market shifts.
Macro data isn't the only thing moving markets. Geopolitical policies are actively reshaping entire sectors right now. Recently, a proclamation was signed implementing sweeping ad valorem tariffs ranging from 10% all the way up to 100% on imported drones and their components. Citing national security concerns, this policy is designed specifically to drive import substitution and aggressively support the domestic U.S. drone industry.
And the why behind these tariffs is incredibly obvious when you look at the data. DJI held a staggering 70% dominance in the U.S. commercial drone market last year. These new tariffs are directly aimed at leveling the playing field. As a result of this shift, the document notes we've already seen domestic drone concept stocks surging this year as they anticipate capturing that massive market share.
Section 6. Ackman's Netflix redemption play.
This is one of the most compelling institutional redemption arcs in recent memory. Back in January 2022, Bill Ackman bought in so heavily to Netflix that he became a top 10 shareholder. But then, as the Fed aggressively hiked rates and post-pandemic subscriber growth turned negative for the first time in a decade, the stock just cratered. By April 2022, he capitulated, dumping all 3.1 million shares for a brutal $430 million loss. He publicly admitted his timing was completely wrong. But fast forward to 2024, and he's back. He has re-entered the stock, purchasing another 3 million shares. So why step back into the fire? The fundamental logic outlined in the source is pretty clear. He bought back in after the valuation was essentially halved from its peak. Netflix now boasts a forward price-to-earnings ratio of roughly 20x, alongside an expected earnings growth of 42%. Combined with their undeniable industry leadership and massive user base for monetization, Ackman clearly sees this as a highly rational entry point. It's really a masterclass in separating a good company from a bad entry price.
Section 7. Market liquidity and the crypto indicator.
Let's tie all of these micro strategies back to the macro reality. Bitcoin recently lost its $63,000 support level, facing downward pressure testing $62,000, with a potential technical floor down at $58,000. This weakness in highly speculative assets tells a larger story. The source describes the current market like two brothers sharing one pair of pants. When one puts them on, the other is left exposed. Because interest rates remain high, overall market liquidity is actually quite thin. Capital is just rotating frantically between sectors to keep the broader indexes afloat.
Which brings us to a final, provocative thought from the source document. If the major indices are being held up by rotating liquidity rather than a rising tide of fresh capital, how sustainable are these current highs? Beneath the calm macro surface we discussed at the beginning, this hidden anxiety is exactly why understanding these data points and observing these specific strategic plays is so critical right now.